Very warm welcome, and thank you very much for joining us today for our quarterly charity-based webinars. There's two of us on the call today. Myself, Harri Lloyd-Davies, I'm one of the charity partners here at Bevan Buckland LLP, and I'm joined by Michael.
Hi, I'm Michael Jones. I'm also one of the charity partners at Bevan Buckland.
And you know the webinar today is entitled, as it says on the screen, "Practical Tips on Ways that Charities Can Mitigate Their Financial Pressures." We are going to do a little bit of tax today, so both my Mike and myself are not tax partners, but we're going to talk a little bit about salary sacrifice as well as a couple of other things. But hopefully we'll be able to get through that well. So I'm just going to start by just flicking through a couple of slides just to let you know a little bit. So hopefully some of you saw that we sent out a survey to our charity customers and we had a number of responses from charities who aren't customers of ours, just to see what their plans were and how they were dealing with the impact of the cost increases that are going on at the moment. We're really pleased to get very good response from the survey. And just to give you a bit of context to kick off, we had I think over 50 different charities came back. The majority, as you can see, just over 40% of relatively small charities, but also quite a lot of bigger charities were employing quite a large number of staff, and then a number in between. So just to give you a little bit of a context, there's quite a broad range of responses, which is, I think, a very useful thing because it helps us understand, the impact across the range of different charities. And the main thing that we were really trying to get our heads around and trying to understand what was happening within the sector was what was the impact of the increased national insurance and the national living wage going to have on the charities. And as you can see, the positive, I think, from our perspective, and we sent this survey around at the beginning of the year, was that the large majority, so three quarters essentially of charities understood the impact that these changes are going to have on their charity and what the financial costs are going to be. But as you can see, I suppose the other way to look at that is it's potentially worrying that almost a quarter either didn't know what the impact were or unsure as to what the impact was going to be. So I thought, just to kick things off today, I just want to remind us all. I know it's kept coming in now in a couple of weeks' time, but just make sure we all understand what that is. And again, just to put it in context, I've certainly spoken to two charities in the last month. Both of whom thought that they understood what the impact was, both had actually misunderstood it and probably underestimated the impact of the changes. So, kicking off with the additional employers' national insurance. So, I'll just recap what the headlines were. So these are the changes announced in the budget back in November last year. And essentially there are two main changes and this only impacts employers' national insurance. But the first thing was, and this was, I'd be honest, broadly expected. Everyone had seen it coming. It had been fairly widely trailed. The rate of employers' national insurance increased from 13.8% to 15%. So that's what you pay on top of the wage to the employee. You also have to make a payment of tax called employers' national insurance, and that rate went from 13.8 to 15%. As I say, most people saw that coming. The bit that people didn't see coming, and both the charities I've spoken to recently who I think had misunderstood the changes, they'd seen the rate increase, they'd missed the second bit, which actually is probably more important. And that's that as of today, so up until March 25, you start paying employers' national insurance on salaries above 9,100. And that has dropped now to £5,000. So just to put that in context there, so you can see at the top of the slide. So if you were paying someone today a salary at a part-time member of staff, and you're paying them £9,100 a year, you wouldn't be paying any employer's national insurance at all. But from next month, that same employee is now going to cost you an extra £615 to employ that person in national insurance. So that's a big increase. That's about 6 or 7% on someone like that. Now that percentage increase grows, as you can see, as you go up. Someone on 30,000 a year, the extra cost is only £866. On 50,000, the extra cost is just over £1,100. So proportionally a lot less, but still a pretty big impact. The median is typically around 850 to £900. So if you haven't done this calculation yet for your wages properly, what I'd suggest is take the number of staff you've got and then times that by about £900, and it'll give you a pretty good idea what the additional annual cost is going to be from next month. There was good news though. So as I say, the bad news is that the amount of NI that most organisations are going to pay has gone up. But the good news was you get something called an employment allowance. And again, this is something we often see a mistake that is often made where companies forget to claim their employment allowance. There have been times in the past where it was effectively applied automatically. You now have to apply for it. So if you're not claiming your employment allowance, please make sure you are. I think you're still in time to get it claimed for the 24-25 tax year. But that figure is going to increase. So if, for example, you've got 5 staff, yes, your employer NI bill might be going up by £4,000 or £5,000. But the good news is because the employer's allowance is going to go up by £5,500, in reality, it's not really going to cost you any more money. But for bigger employers, if you're employing 20, 30, 40 staff, you're certainly going to see an increase. And as I say, the bit that it really hurts is if you've got a lot of part-time staff, and we've certainly, a lot of the charities I've spoken to in the last few months have got a lot of part-time staff for a variety of reasons. The impact is probably greater because you're paying that extra 600 odd pounds or £700 for every member of staff, whether they're part-time or full-time. So if you've got a full-time equivalent or two part-timers now, it's going to cost you more in employers NI than it did before. So that's a quick sort of overview of the changes. Hopefully, that's a useful recap for those of you who are already aware, but puts a bit of information out there for those who didn't understand them. But I say that the aim today was not just to look at this, but also sort of see what charities are doing to try and sort of reduce these costs and to get out to them. So before I come on to some practical tips about how we can reduce costs, and I'm going to hand over to Mike, I just wanted to sort of give some feedback as to what all the other charities are looking to do, how everyone is trying to deal with these additional costs. And as you can see, their top of the top plan essentially is to look for additional funding sources. And that's great. But the worry I've got is that if everyone has got the same idea, and you can see they're almost 80, certainly over 70%, almost 80% of charities have decided to go out and get extra funding sources. In reality, I can imagine that the grant funders are getting sort of fairly inundated with additional requests. And one of the big risks for me is if you're a charity that's relied on or been successful in getting a grant out of a certain organization for several years, is that grant or giving organization now getting a lot more requests? And is there a risk that actually the money that you thought was in the bag because they've given you a grant for the last 5 years potentially might be reduced or even not given at all because there were other people looking at it? Second on the list, reducing other non-payroll costs. And again, I think that's a very sensible solution. Far lower. Look, about 40% of charities were looking to reduce other non-payroll costs. Again, the worry I've got here is that a lot of organizations are putting up their prices at the moment. And as most of you will be aware, Bevan Buckland, we look after a wide range of sectors. We don't just do charities. And generally there's a lot of doom and gloom around in sort of December, January time, as businesses were trying to work out what are we going to do about all these extra costs that are impacting us? How are we going to what are we going to do about it? How are we going to sort of get through this period? And actually, I've sensed a little bit of an improvement in the mood, if I'm honest, over the last couple of months, because most, I think, have realised and accepted actually we've just got to put our prices up. So I expect you will find that a lot of your prices are going up, and not by 1 or 2% like inflation. Most organisations I'm speaking to are trying to increase their prices by probably at least 8%, if not 10%. And certainly a lot of the local authority rates bills are going up by pretty significant figures. So something to be aware of, that whilst you might be trying to reduce other non-payroll costs, it's going to be a bit of a challenge if lots of organisations are upping their prices. Increasing charges, charity users, third on the list. Obviously, great if you've got that as an option, but not available to everyone. The positive for me was that the more drastic ones, the ones that really will have a massive impact on the beneficiaries of the charities, things like the reduction in the services offered and redundancies of staff were down the bottom of the list. So less than 20% of charities looking at those sort of things, which is very positive in my view. The worry I've got is, as I say, if the top two or three end up being harder to do than what we expect, will charities then be forced to go down the route of either reducing their services or sadly having to let staff go to make ends meet? So, as I say, that's the feedback that we got from our survey. As I say, hopefully that's been useful and added a bit of context to you. But now I'm going to hand over to Michael, who's going to give us a some practical tips. And we're going to start with salary sacrifice, because this is, if you haven't heard of it, is a good way to potentially sort of mitigate some of those costs. So, Mike, over to you.
Thanks, Harry. Yeah, so first of all, touching on what Harry said there, we've seen charities are probably as badly affected as anyone with the NI increases, just because if you're working within the company, you can actually get corporation tax saving on the increased costs. But most of the charities, because they don't pay corporation tax, wouldn't actually see this small benefit as well. So trying to find ways that you can make the most out of your funding without actually impacting your employees. Yeah, and this is something that we internally looked into 12 months ago as well. So a salary sacrifice is where you take a slightly lower salary. So in fact, you sacrifice part of your salary for another benefit. So whether that's a contribution towards a pension, a cycle to work scheme, all it's trying to do is actually give you a better solution. So what happens in practice is you'd have your agreement there. You work with your employer. You agree to take a lower salary in exchange for an extra contribution. So that if you were paying a 3% into your pension, you take a slightly reduced salary, and the employer then will make up the pension. So you don't lose out as an employee, but actually both sides can win. So when actually looking through it, these aren't an exclusive list. So the main ones we're seeing is pension contributions, especially across charities. Most charities will have a pension unless the staff are very low level or part-time, but any full-time employee will need to be part of a pension. There's still cycle to work schemes out there, so that's a government-backed incentive. So it's trying one to help with people's health, but otherwise it's giving you access to bikes through a number of different providers where you can save the tax on NI, and at the same time you haven't got to pay that initial outlay. So the way the scheme works is that you pay it over a 12 or 18 months period to acquire the bike. We'd probably see it more. We haven't seen a significant amount yet, but electric car schemes work in exactly the same way, is that it comes straight through your payroll. So you give up a bit of your salary, and the employer then would pay for the scheme. The childcare vouchers, it's still there for people that are within the scheme, but it's closed to new employees a number of years ago. But again, it's an extra way of gaining your childcare vouchers as tax efficiently as possible. So we click on one, Harry.
Yeah.
So looking through now. So we're trying to look at it now. So a little introduction of salary sacrifice, and then realistically, what are the benefits to it? The main benefit, in short, is everyone pays a bit less tax. So with the employee giving up a little bit of their salary, obviously the taxable salary drops down, so the tax they actually pay on that salary does drop down in line with it as well. And then you save on the national insurance contributions to it. So we've got a couple of examples later on, but what we've seen is where the employee gives up a little bit of their salary, the employer actually makes good then on say the pension pot, or extra payments on their behalf. So both sides are taking advantage of the benefit. And strangely enough, where you're actually reducing a little bit of your salary, the take home pay actually increases as well. So it's a little bit of a no-brainer to a point, but there are some drawbacks, but we run onto those. From a recruitment point, so if you're trying to attract staff, which we know is difficult in the sector, having an extra benefits package will work for you. We know a number of the charities that we're acting for haven't given pay rises, or have given notional pay rises for a number of years. So if you can get an improved benefits package, attracting staff or maintaining staff numbers will work on your side. And then with the employers, if they're saving a little bit of money, either they can reinvest it back into the charity, where they can give it back slightly to staff, or through other means as well. So hopefully it's a good bit of news for both sides. A little bit of a sort of setting up. So it's relatively straightforward to set up. We've set it up for a number of our clients internally. There's a little bit of admin to go through. So you can't just, the charity or the employer can't set up themselves. No, it's a case of they have to get in contact with potentially a payroll provider. So we've done it for clients. If you've got other outsourced people, you can use those. But the employer can't sort of force on anyone. So it's a case of all employees need to agree to it. It then becomes a change to their actual contract. So you will need some HR advice just to make sure your contracts are revised and sort of drawn up correctly. But fundamentally, it's a case of the employee agrees to it. The employer then facilitates a scheme. I know Nest, also some of the people's pensions, they've got different ways of setting up their side. So there's a couple of little bit of setup issues just to get the people who are taking part of the salary sacrifice into the correct scheme, but then it also get processed monthly as a normal payroll would be. One thing to sort of note is that if you've got people, some people may say yes, some people may say no. It's just making sure that the individuals are treated correctly. So if they're not part of the scheme, you process them as normal, and those that will go through have to run through it sort of slightly different, but it's also done as part of the setup through your payroll provider. And then looking through, so whilst there are benefits to it, it's making sure it's not right for everyone. So if you have people that are, they do have life cover, they maybe have illness policies, your salary does often sort of drop down because you are sacrificing part of it. So it could impact potential cover you get, or potentially if you're going for a mortgage, your salary could be lower. So it may not actually get the level of funding that you want. We are
I think it's
seeing.
worth mentioning, Mike, because we were chatting to our payroll team and Tina, who's the manager there this morning, and I think there's probably although these schemes have been around for a long time, I think there's a better understanding, particularly with mortgage lenders, etc. at the moment. So whereas they always used to look at your sacrifice salary, I think now they will potentially, there are certainly some mortgage lenders that are more willing to look at the pre salary sacrifice because they know ultimately you could always change your mind and go back to what it was. So it's something you certainly need to consider, but it's probably not as big an issue as it was sort of 4 or 5 years ago, in terms of mortgages, but certainly something to consider. Yeah.
And then the other two main parts is coming around to your national minimum wage and your sort of statutory maternity pay is making sure that you still pay to the relevant level. So it's a case of you can't actually reduce your salaries down. So if you've got someone on minimum wage anyway, this scheme wouldn't work because then their earnings would be below the minimum wage, and you then open yourselves up for non-compliance with those standards. And then it's being mindful of any entitlement to benefits as to if your salary is slightly low, it could have a slight knock-on effect to maternity pay and other schemes. So it's got to be looked at on an individual basis. I said there are some wins to it, but it's just be mindful of it. It's not always a one size sort of fits all. So have every employee looking at it, but making sure you are giving them the advice to be mindful of before they actually make that decision. And then we've got a couple of examples here. So these are almost a couple of scenarios. And then we've got a couple there with some sort of showing extra savings as well. So as examples of pension contributions, we haven't got many charities where employees are only 50,000, but that's sort of where we sort of pitched the first one. So looking at if you had an employee on 50,000, the employee could sacrifice 2,500 of their salary into the pension. So the employer pays that directly. So from an employee position, the pension part exactly means the same. The 2,500 still going on there, but actually the employee wouldn't pay tax on it. So the taxable income gets reduced. So you'd take your 2,500 off your overall salary, which then saves the employee hundreds of pounds then over the year based on savings of tax and saving on national insurance. So at the high level, I said a sizable salary deduction can actually sort of benefit both the employee, and the employer would save on the national insurance. And then from a cycle to work, so this is where you can buy your bike over a short period. You get a loan, in essence, a loan from the company, but then you pay it back over say 12 to 18 months through your payroll. And based on a bike that's worth sort of £1,000 at the moment, so you'd save £366 based on sort of current retail price. So if you had employees that wanted to look for a bike, it's definitely worth having that discussion with them because one, they can benefit by either getting a better bike, getting some extra accessories to it, just to make sure they're safe. At the same time, they can save and spread the costs over a period as well. So a good couple of wins there. And then from a healthy point, it does promote sustainable culture. It does promote well-being. We've got a number of staff ourselves that do cycle back and forth to the office. It's definitely a good, healthy option compared to some of the traffic around. But I know these examples were based on the current rates as well. But now we've got a couple more where they're actually based on their upcoming rates as well. So let's run through the next couple. So we try to break this down now between what the employer would save and what the employee, just to sort of make it easier to break through. Using a slightly lower salary here, so using a £30,000 salary, which is not that much above minimum wage nowadays, the way that the rates are going, and contributing the 5% to their pension. So from an employer, if you had one member of staff, and they'd sort of sacrifice 1,500, you'd save 15%. So it'd be a saving of £225 per member. It doesn't seem a big number, but then if you are a charity that's got a lot of sort of social workers or sort of care sector, 50 members can actually be quite a standard number. So when you actually multiply it across, you could be saving yourself over £11,000 a year just by having them to sacrifice it. So you think from a company side or a charity position, the savings there can be run into the tens of thousands. So then if we think, okay, I'm the employee, what's the benefit to me? If we sort of flick on, we sort of show what the employee can save. So we've got a couple of same salaries, same rates, so nothing has sort of changed across the scenario. And there's two different ways that the sort of pensions are currently run through. So it's either at source or net pay, but then we're comparing it with a salary sacrifice. So using exactly the same salary. The highlighted point, which we'd mentioned, is that the total taxable salary does drop because you are giving away a little part of your salary. But then, so middle part of that table, you are paying a little bit less tax. So you're saving sort of £300 tax when you actually sort of come across the two different methods. But then from the take-home point, so if you were an employee, what are you concerned about? The two parts you're looking at is how much is going into my pension and how much hits my bank account at the end of every week, every month. So when you actually look at your annual salary, using a salary sacrifice, you're actually saving, you're gaining £120. So it's £10 a month extra, albeit foregoing a gross salary of £1,500. So it shows both sides can win here. So if you sort of look at both of those, you are looking at sort of £400 a month saving for both parties. So definitely worth a consideration and have that conversation with your team. I think
And
that's
just a couple of Yeah, I was just going to sort of pick up. There's a question coming. I'll jump onto in a second, but I think it's the decision you've got to make if you want to go down this route. Essentially, is that a lot of organisations don't basically pass the benefit on. So you've got three options. Either the company or the charity can sort of retain the employer NI benefit. Some organisations, as a way to sort of boost the employee staff, will pass on some or all of the benefit as well. So if from a charity perspective, you'd rather use this as a tool to sort of make your staff better off and try and improve staff retention, you want to hand over all the benefit, that can be done. You don't have to keep it for the charity if you're in a stronger financial position and you're able to do that. We've had a question in the chat. If anyone else has got any questions, feel free to either stick them in the chat or just unmute yourself and ask us directly. But yeah, I think it's right, Mike. Is it there's not a formal scheme. It's not something you've got to sign up with HMRC or anything. It's just you'll need to tell your pension provider so they know what you're up to and make sure they're happy to accept it, purely gross contributions. And as you mentioned, it's speaking to either your in-house or your external HR advisors to make sure the contracts are updated. Is that right? For
yeah.
pension salaries advice now. Yeah.
Yeah, I think it's looking through, just double check what they're actually trying to use as a salary sacrifice as well. But yeah, using the pension, the ones that we've mentioned are very standard. There are other companies out there offering other benefits where people can sacrifice for as well. So I think if you are thinking of something that's not, say, one of the four that are common practice, and you're looking at something else, I think it's sort of get some advice first, just to make sure they're not treated as an additional benefit, and you cause yourself some other tax issues. But from a pension point, it's more of an internal administration and that one-off liaison with your pension provider.
Brilliant. So say, if you've got any questions on this, or you want to know whether it would work for your charity, our payroll team would be happy to speak to you or speak to myself or Mike, and we can talk through whether it's right for your charity. But it's something we are expecting a lot of organisations, particularly with sort of the higher paid staff, to look to do, because it's an easy way for actually the staff and the charity to benefit without costing, without either one really losing out. I just put, we sort of talked about practical tips. So I think we've got 5 minutes or so left. So just to finish off, I was just going to run through a few other ideas, and which certainly we've seen implemented very successfully in other organisations. Because going back to, I'll flick back to the slides we were on earlier. And is that, reducing other non-payroll costs. So it's just some of the practical ways that we've seen people successfully achieve that. Um, some of them are really simple. And I remember when this is going back a long time now, but in the financial crash of 2008, when I was looking at the Bevan and Buckland position and thinking, right, is there anywhere we can save a bit of money? And we literally just sort of printed off the nominal ledgers. And it's amazing how many things are set up on direct debit and things like that. And you find sometimes old antivirus software subscriptions and things like that, which are going through on direct debit, and they may no longer be relevant. So although it's really simple, it's just a very good exercise just to either get a month or two of bank statements or a month or two of your accounting nominal ledgers, and just go through it line by line and make sure that everything that you are paying, particularly by direct debit and standing order, is still needed. And is there anything you can save? Because if you can find a few things which are £20 a month or whatever, all of a sudden that can add up to quite a lot of savings in the longer run. Another practical tip, which I think is just to negotiate. And as I say, there'll be an awful lot of organizations, I think, trying to push up non-payroll, other costs. I don't think you're going to get very far if you ring up the local council and say, oh, we're not going to pay the 8% or the 7% rates increase. You're probably going to find landing on your doorstep anytime soon. But certainly there are other organizations where there probably is a little bit of negotiation. And sometimes it means you've got to reduce the scope, or if it's, for example, insurance, you may have to reduce the cover. But that might be a risk worth taking to reduce the level of service or the level of insurance cover, for example, to try and save a little bit of money. And another sort of thing I always think is worth looking at is outsourcing. So particularly if you do find yourself in a position where a member of staff leaves for any reason, do you have to replace them, or is there an option to buy in a sort of a freelancer or not take on the full cost of employment? So a lot of these things I think are about, can we just do things slightly differently? Can we come up with a different way to achieve that? And the other one, just thinking back again to ourselves, I suppose, but I think this applies to an awful lot of organisations. And it was phenomenal, sort of in those post sort of COVID years, to see the drop in some of our organisations in terms of their travel and events costs. Um, and in particular, I can't name them, but one of our organisations used to spend about £200,000 a year going around different events around Wales. And they've reduced that now. That overall cost between the travel and the accommodation is over halved. I think it was 80,000 last year. And actually, they think they've actually probably are giving a better service to their members because they're doing far more of it remotely rather than relying on them to turn up in different events around Wales. So, don't be afraid sometimes to do things differently. And certainly for me, travel costs are often a good source of savings. And also offices, we go out and do audits at the moment. There's a lot of fairly empty offices and things like that we go to visit. Is there an opportunity to reduce costs by reducing your footprint? Um, A couple of other sort of slightly more sort of generic ones, but number one, and you would expect this from an accountant, but I love budgets. So I think it's a really, really good and important strategy just to set a budget at the beginning of the year, and then try and report against it to try and help you understand where are we spending more than we should be. So budgeting, and I'm not going to go into detail on that. We do a whole separate course just on budgeting. So we'll probably do that one later in the year, given it's probably very topical at the moment. But if you don't set budgets, I strongly recommend you jump on that course with us later in the year to go through that. And the other one that I often think gets forgotten about, but we've seen a lot of this, particularly in the not-for-profit sector, and I think it's been very successful, is collaboration. And what I mean by that is if you've grown as a charity now and you're at the stage where you could really do with some in-house HR support. It's getting very expensive to leave an external organization do it all for you, but you aren't quite to that stage where you can afford a full-time in-house person. Have a think. Are there other similar sized charities to yourselves that maybe you could work together to share resource? We've certainly seen this work very well in things like the housing sector, where organisations have sort of co-employed someone, and it's worked in procurement, HR, internal audit. So there's some very successful organisations out there that have already demonstrated that this can work. So it's certainly something to consider. And it's always been, the story I sort of finish with. It's always frustrated me a little bit with my farming clients. Because generally you go to most farmers and you drive onto the yard and there's probably 200,000 or 300,000 pounds of equipment sat there, which sits idle for sort of 50 weeks of the year. The baler that only gets used for those 2 weeks in summer when the sun is shining, but they've all got their own baler. And in reality, I accept it's because unfortunately the sun only shines for 2 weeks, so they'd all want the baler the same 2 weeks. So it doesn't work in some industries. It doesn't always work for charities. But actually, I think for in many areas there can be a benefit to working together to try and collaborate to find certain roles to reduce costs. So I think that was it from me. If anyone's got any questions or comments, please either drop them into the chat or unmute yourself and ask. I'm covering anything from salary sacrifice to other cost savings. I don't think there are any. So all it remains is to say a huge thank you for you all for attending. I hope that's been useful and has given you a few ideas about what the impact is going to be, how salary sacrifice works, and other ideas to save costs. We hope to see you later in the year for the next webinar. Any final comments, Mike?
No, I think the only because that slide's open is just be mindful of if you are chasing additional funding sources, just think of what the charity's doing and is there going to be additional costs to fulfill it. But that's just more so around the governance.
Yeah, no, fantastic. Pretty well, as I say, thank you all very much for attending. We hope it's been useful and we will see you later in the year. Thank you.